Good morning, everybody. Welcome and thank you for joining us for our 2020 Virtual Property Conference. This is a three-part virtual property conference series brought to you by Real Estate Investor and Rode Associates. My name is Neil Peterson. I'm the founder and editor-in-chief of Real Estate Investor magazine and of the REMAG digital content platform. And for investors, property buyers, landlords, and property practitioners and professionals. And I'm really honored to be your host and moderator for this virtual conference today. And I want to welcome you all and thank you for joining us. So first of all, to you, the audience, we look forward to your interaction today and your participation. We've got a great lineup of panelists. And so we want the interaction. That's the most important thing, the networking. Also for attendees today, there's 3 CPD points allocated for each series of the conference for registered valuers, associated valuers, agents, and brokers. And we will submit reports as to your attendance of the webinar for you. All right, so without further ado, I'd like to get to today's topic. And our theme for today, part 1 of the 3-part series. And we're running this every 2 weeks. And it's called Peering into the Future of the South African Economy and Real Estate. What does the future hold? And I think that's a big question that we all would really like to know. And today our expert panelists include 2 leading South African economists, a CEO of South Africa's largest JSE-listed REIT, and also joining our keynote presenters on the panel discussion is a leading property economist, property value and consultant. And yes, so let's just have a look at the agenda for today. So we're going to start off, first of all, our first keynote will be Dawie Roodt, and he's going to also be taking a look at the economy for the next half an hour. That will then be followed by Nicky Weimar, who's going to give us a more technical look at the South African economy. And then thereafter, Estienne de Klerk, CEO of Growthpoint South Africa, will be taking us through what he sees in terms of the economy, the effect of the economy it's had on real estate. And then we end off with a panel discussion and a Q&A session, and it's a great opportunity for you to ask loads of questions and to interact. So once again, we encourage you to put your questions into the Q&A box. So without further ado, I'm going to introduce you to our first presenter. He is the founder and chief economist of the Efficient Group. He serves on a variety of investment committees within the Efficient Group. His latest role is that of chairman of Efficient Private Clients, of which Efficient Group is the majority shareholder. He is nationally renowned economist with over 30 years experience. He specializes in monetary fiscal policy and is currently doing extensive research on the possible impact of cryptocurrencies on monetary policy. He is closely involved with the management of client asset portfolios. His interest in international and local politics has grown, and he has become knowledgeable in the field of politics as well. He is ranked as the most referenced economist in the country and received the prestigious Economist of the Year award by Sake 24, a media house part of the Naspers Group, and he has been the anchor presenter of television program on Beit Sake for the last 17 years. He has a master's degree, cum laude in economics, and his career includes being an economist at the South African Reserve Bank, presenting more than 800 and 1,500 radio programs, economic editor at a financial magazine, and columnist for several publications. So without further ado, his name is Dawie Roodt. So I'd like everybody to welcome him and whatever you can from a virtual perspective.
Thank you very much for the invite. My job is to set the scene for 2 much better speakers than me. So my job is to set the scene. I'm going to have a look at the international economy, international politics, some local economics, some local politics, touch a little bit on the president's economic recovery plan. I'm going to an alternative economic recovery plan. And then, of course, next Minister of Finance will present the interim budget policy statement, or the so-called mini budget, what can be expected in a mini budget, and then some advice, some suggestions on how I think people should be, positioning themselves in the current very volatile environment. So let's get going with the international environment, and let me start off with politics. Now, what I think what is happening internationally is what we've witnessed recently is what I call a move to new nationalism. And there are many examples of this new nationalism. This happened long before the lockdown. Brexit perhaps was the beginning of all of this. So the Brits want to go all alone. And that may eventually lead to the breakup of the European Union as well. And I think there's a possibility that the British Union could break in smaller pieces, and I think Scotland is a good possibility that they may decide to leave the Union. So we see this new form of nationalism, and there are many, because usually with this new wave of new nationalism, what one typically finds is things like, for example, put America first, and that means things like, for example, the trade war. So we saw a trade war between America and China, but not only between America and China, many other countries in the world as well. So that is, from a political point of view, is that you get this fragmentation, this period of world integration, politically, economically seems to be at an end, and of course, the virus or the lockdown accelerate those sort of trends. From an economic point of view, things that I think are bad internationally, first point of view, debt levels nationally are the highest. I'm referring specifically to state debt levels, the highest ever in the case of America in the last financial year, $3 trillion. So the debt levels internationally are just keep on going up and up and up, and there's no end to this. Economists have been arguing that there must be some sort of end somewhere. We just don't know. Debt levels at the record high levels, and still nothing is happening, but eventually something is going to happen. That concerns me quite a lot, and I have a suspicion that because of the interaction between fiscal and monetary policy internationally, and that inflation could be just way out of this very high levels of debt. And of course, inflation is a horrible thing. It will lead to, it undermines economic growth. But I think that is something, and especially in countries like, for example, South Africa, we're probably going to see relatively high levels of inflation before the rest of the world. From a monetary point of view, internationally, also weird things are happening as well. We saw, and we're still seeing, central banks internationally doing all sort of funny things, very unorthodox monetary policy approaches. For instance, they've been cutting interest rates to very low levels, and in some countries, interest rates are below zero. And not only short-term interest rates, longer-term interest rates are also at very low levels, because central banks, they embarked on something called quantitative easing, which simply means we print money, and they've been printing money like there's no tomorrow, and they use this money to buy long-term government debt instruments, forcing the long end of the yield curve down and below zero in some instances as well. So that is a weird world in which we find ourselves internationally. Fiscal policy at levels that we never thought possible, monetary policy doing all sort of very, very unusual things, and eventually something's got to give. What that is and when that's going to happen, nobody really knows, but I'm pretty sure that we're living in a very, very dangerous world. Maybe just another comment I want to make about the international economy, and that's a question I get all the time, and that is, are we seeing the end of the US dollar or the beginning of the end of the US dollar? The short answer to that is certainly no, not yet. And the reason for that has to do with the fact that the US dollar is the dominant currency in the world, but also because the US dollar is the dominant trade currency, but also the dominant reserve currency in the world. And if you want to be the dominant reserve currency in the world, you have to have a very liquid and a very deep capital market behind that, and that is indeed what the Americans have. So, and to unseat the US dollar as the world's dominant currency will take quite some doing. And that is something that is not going to happen anyway, not going to happen soon. If there's any currency that can potentially rival the US dollar in the short term, I think it will be the euro, because they've recently started, well, consolidating their capital market by issuing euro bonds. They're in the process of doing that. So potentially the euro can become that dominant alternative currency. We're not there yet. So the dollar is going to remain the world's most dominant currency for a long time. Let's move to South Africa. A few comments about politics in South Africa. We know that we have the tripartite alliance in South Africa. Maybe I can just make the following comment, is that the ANC and ANC-led government has been the most destructive force the South African economy has ever seen. I'm going to show you, I'm going to mention some numbers, I'm going to share some trends with you, but let's just understand politics in South Africa. We have the tripartite alliance with the senior party being the ANC. We have COSATU, which essentially represents the civil service in South Africa, organized labor, but particularly the civil service. And then we have the Communist Party, which is kind of a junior member of the tripartite alliance, but they're still important because they are kind of the ideologues. They provide the ideological backbone of the tripartite alliance. There are three questions that need to be answered before we can fix the economic issues in South Africa. Three political questions. The first political question, we need to know who's in charge. It seems to me as if the president has been consolidating some of his powers recently, but there's still a lot of infighting. We all know that. A lot of infighting. Who's really in charge really depends on who's opening his mouth at that moment. So the president, without a doubt, made some progress recently, but who really is in charge of the ANC or of government, for that matter, is still an outstanding issue, and things can still change. The second question is, what ideology are we following here? And that is pretty much related to the question who is in charge here. Because the ideology, sometimes we get a very, very far left ideology, and sometimes we only get a left-wing ideology. So I guess we have a leftish government or a far left-wing government, depending on who's opening his mouth at that moment. And of course, the Communist Party is partly to be blamed for that. And a very good example is, for example, Tito Mboweni saying that South African Airways must be closed down, while Pravin Gordhan says that South African Airways, come hell or high water, must be kept on forced feeding forever and a day. The third question that needs to be addressed before political question, before we can fix our economic issues in South Africa, is the question on whether whoever is in charge of government or of who is in charge of the state in South Africa, will they be able to control COSATU, especially COSATU, but generally speaking, organized labor. Because one of our biggest challenges in South Africa is we simply have to cut back on state spending. And that inevitably means we have to cut back on the wage bill. And that means that COSATU is going to be going to get very angry. And we know that COSATU are very well organized, perhaps not very productive, but they can be very, very destructive. And that is a question that is still outstanding. Whoever's in charge of government, can they actually get COSATU to toe the line? All right, a few comments about the South African economy. Like I've said, we need to fix the political issues before we can fix the economy in South Africa. And before we've done that, the economic issues will not be able to address those issues. A few things, and let's have a look at the South African economy BC, and that is before Corona. And maybe let me just make a comment about the coronavirus. The coronavirus is not causing this havoc to the world economy or to the South African economy. It is a lockdown. It is important to make a distinction here. Of course, how many people dying, and of course, it's horrible for every life that we do lose in the country, but it's the lockdown and not the virus causing the damage to the local and international economies mostly. The South African economy was in very deep trouble before BC. On a per capita basis, we've been getting poorer for the past 5 years. We were in a so-called technical recession before the lockdown. And also the other things have been happening in the South African economy. State-owned enterprises have been mismanaged financially and operationally. The local authorities, 3/4 of them are mismanaged. The national departments are horribly managed. The South African, we were in a mess before the crisis. And then it was the lockdown, and all sort of things are going to go really south from here onwards. And you have a couple of numbers that I can share with you in terms of what can be expected during 2020. And some of these numbers we already have. We know, for instance, that the economy absolutely collapsed in the second quarter. We know we've lost 2 million jobs already. We're probably going to lose more than 100,000 businesses. And the South African economy, my estimates is for a contraction in the current year of 2020. Now, like I've mentioned, the economy was in a recession already, 2 negative economic growth quarters from last year. And now we have 2 extra negative economic growth quarters. But this is just not a normal recession. A recession refers to a cycle, typically. We are not in a typical economic cycle, a down phase in an economic cycle. This is completely different. What happened to the South African economy, things were broken, and things are broken. This is not a recession. It's not even a deep recession. This is, as far as I'm concerned, a deep recession. The South African, we are in very deep trouble. Like I've said, 2 million unemployed extra. A huge increase in poverty in South Africa. Per capita GDP probably going to fall by about 15% this year. Record high levels of unemployment and luck. And of course, it's not only the private sector that's being affected. We see that the state itself, and I'm going to talk about that just now, the state itself is also in very deep trouble. Huge pressure on state revenue, and revenue of the state is going to be well in excess of 300 billion less than originally estimated. So the lockdown is causing all this damage to the South African economy. Maybe just a comment, and like I've said, you know, every death is one death too many. But nobody that I do know of is currently estimating more than 20,000 deaths because of the virus. I've made some calculations. The biggest nasty out there, The biggest killer out there is not a virus, it's not malaria, it's not AIDS. The biggest killer out there is poverty. And because of this massive increase in poverty that we are experiencing, we are, and any questions on I've done that, I will be happy to share this information. But over the next 10 years, we're probably going to lose approximately 300,000 lives because of the increase in poverty. Far more, far multiples more than a potential life loss because of the virus. Poverty is by far the biggest killer, and the lockdown is going to result in a huge increase in poverty and a huge increase in lives lost because of the increase in poverty. Okay, the president's economic plan. One or two comments about the president's economic plan. The plan basically is as follows. It is centered around infrastructural investment. The state plans to spend approximately 100 billion extra on infrastructure. They will provide certain guarantees to the private sector, and the idea is for the private sector to come to the party and to invest nearly R1 trillion. So the whole idea is for infrastructural investment, state-led infrastructural investment of approximately R1 trillion in South Africa, and that is going to lead to all sort of new jobs. That's the plan of the president. Of course, jobs is at the center as well. The president is talking about 800,000 new jobs that will be created. And of course, another emphasis is on the, let's call it the internet economy, broadband, more access to broadband, which is all good and well, and certainly one can support that. One of the biggest challenges, and again, the president did not answer this one, is about Eskom. The total outstanding debt of Eskom is approximately 500 billion rand. Eskom is financially, operationally sustainable as it is. Somewhere we have to get 250 billion rand. The president didn't answer that question. I wonder if the Minister of Finance is going to answer that next week. I don't know, but we need answers to that. And then miraculously, we're going to have a lot of extra electricity over the next 2 years, and electricity problems will be something of the past, which I certainly doubt. So that more or less is the plan of the president. Nothing really new to the plan of the president. And I am also afraid to say that I am not holding my breath. I don't think this is going to lead to a 3% economic growth as estimated by Treasury. I think the South African economy is in for some difficult times for a very long period of time. So, but here is an alternative plan. Remember, the president is basically the chief civil servant. He runs the state on our behalf, and he's services to us, of the country. Now they're planning to do much more now. That's the plan of the president. More infrastructure, more on education, more on health services, more. Also make sure that they pay their electricity bills, and make sure they collect the taxes that are due to them, and make sure that it's not catered deployment, but actually efficient people being employed there. So that is part of my economic turnaround plan. If I was the president, make sure the local authorities work. Simple as that. It doesn't matter if you plan all these huge extra spending and you can't get somebody to answer your telephone at the local authority. That is the first contact point of a port of call for a business. And if you can't get joy from a local authority, then it doesn't matter what plan you implement, it's just not going to work. The local authorities got to be sorted out. Of course, the provinces with that as well. Fortunately, the provinces are not that important in South Africa. And then the state-owned enterprises. Because of a lack of electricity in South Africa, the economy cannot grow faster sustainably, 1.5% or so, because of the lack of electricity, because of the mismanagement of Eskom. Eskom, that's just financially and operationally totally unsustainable. Yes, there seems to be an urgency in breaking up Eskom. And not only Eskom, we've got many other issues as well, but Eskom is perhaps the biggest one. So where is the money from Eskom going to come from? Shouldn't that be included in the economic plan of the president? Give us clarity on Eskom, on the breakup of Eskom, and some timelines on Eskom as well. And then South African Airways. I am not sure that government actually do want the state-owned enterprises to work because it's a big wastage of money. South African Airways is an excellent example. How on earth do you plan to keep on keeping South African Airways alive, spend another 10 billion at least, which is also going to be wasted on South African Airways, when people are going to bed hungry at night? The priorities, I just cannot understand. And lastly, what should be included in an economic plan is the local departments. Now, the biggest local department is education. Education costs more than and it's not going to be education for long. Soon, interest on state debt will be the biggest expense item. But education in South Africa, despite the fact that we spend more than most countries in the world, education is a mess. The quality of South African education is not only bad, it's sometimes the worst in the world. Perhaps that should be part of our economic plan. We want to have fast internet, but our grade fours can't read and write. That should be a first priority. So that's my economic plan, to make sure that the stuff that the state is supposed to be doing, that actually works, and only later forget about fancy bullet trains and cities in the sky. Then next term budget policy speech was postponed. Now, I've been analyzing the fiscal accounts for many, many decades. Uh, we've never had, as far as I can remember, an emergency statement. We had that in June, and I can't remember of a single time when the medium-term budget policy statement was actually postponed. So here are a couple of things that I expect will be covered in the medium-term budget policy statement. First of all, revenue shortfall. The revenue shortfall is probably going in excess of 300 billion more than we already estimated. And it could be even worse. Currently expects about 300 billion shortfall. I think it could be more than that, 320, 340 billion or so. The tax revenue is under tremendous pressure, which means that they need to get more taxes in, which will not happen until the economy starts growing. But I've got a suspicion that the minister will make some comments about possible introduction of new taxes, which will only be announced next year. In fact, it could happen now, but it's not usually the platform. Between months, we will pick things up, like, for example, the possible introduction of another wealth tax. We have a number of wealth tax already in South Africa, so another wealth tax, maybe a further increase in personal income taxes, and the expect increases. On the spending side, the minister's got to find money to spend on things like, for example, the additional grants, another 6 billion, some billion rand that he needs to find some spent on South African Airways, that vanity project. And of course, especially on the state, where is this money going to come from? And how is he going to reprioritize some of these spending items? I'm pretty sure that his colleagues, most of them, do not understand that the minister is going to tell them they have to cut the budget. Who's going to cut it? Will it be education? I don't know. It's going to be very difficult, because the minister also promised that much of this additional spending will be done in a fiscal neutral manner, which means that you have to cut somewhere else. Let's see how he's going to do that. And that actually pushes the political question to the front, and who's in charge and what ideology is being followed here. Because Tito Mboweni and some of the other guys are certainly not sitting around the same fire in terms of ideology. And then, of course, the big question, what's the fiscal deficit going to look like? That's very important. Standard & Poor's this morning already said that they're very concerned about the fiscal account. I don't think Tito Mboweni will be able to keep the fiscal deficit at the reasonable levels. My expectations for fiscal deficits about 17% of GDP. And then the big question, what's going to happen to debt? The Minister of Finance wanted to stabilize debt in 2 years' time at around about 87% of GDP. Even before the most recent announcements of additional spending, that was certainly not possible. So is Tito Mboweni going to relax these estimates? Is he going to say, listen, I've tried to, I'm not going to be successful now, I'm rather going to go for 100% of GDP target? And if that is the case, then I'm afraid his credibility will be out of the window. And already most estimates, most analysts and economists suggest that the 87% peak for debt to GDP ratio is not going to be achieved. I agree with that. I think we probably are heading for debt levels in excess of 100% eventually. And then, of course, another big question, will Tito Mboweni give some answers on Eskom? Dangers, outstanding dangers that I think we need to be aware of. One is the possibility of foreign exchange regulations, and there are already signs of that. For example, if we are prevented from if you're immigrating, you're prevented from taking your pension money out of the country, that is nothing but a form of foreign exchange regulation. I believe that more of that could be on the cards eventually. Prescribed assets, could that be on the cards eventually? Well, the reality is, if you see how much money is available by way of savings in a country, if you look at the fiscal deficit, that use all the available savings. And unless we cut state spending dramatically, I can't see how we're going to get away from this, that prescribed assets will become a reality in one form or the other eventually. The first target, of course, will be the easy one, and that's the government. So Section 28 of the Pension Fund Act is probably going to be amended, not to force pension funds to invest in certain prescribed assets yet, to make it easier for them to invest in certain assets as at first, but eventually the reality is that there just isn't money. Unless we cut state spending, there isn't money available. So get something on that. Then some other questions that eventually needs to be answered. Still, it is official policy of the ANC to nationalize the South African Reserve Bank. They've kicked that ball into touch for now. And then something that is going to become a reality soon is the expropriation of private property, or let's call it what it is, and that's the theft of private property. And that is not good if you want the private sector to invest, but at the same time threatening to steal their property. A few pieces of advice. Let me start off by maybe make one or two good comments, positive comments. The South African Reserve Bank is in excellent hands. Who's doing one of the potential threats going forward is high levels of inflation in South Africa. And as long as Sechekanyago is there, he at least is going to do his part to prevent from inflation getting out of hand. Of course, the political pressure on the South African Reserve Bank will just keep on building up over time. But from now, the Reserve Bank under excellent control by the Sechekanyago is doing an excellent job. Let's hope he's going to stay there. Well, it's his last term now, but let's hope there won't be too much political pressure on him. But believe me, the pressure will build up on the Reserve Bank. The judiciary in South Africa is still independent, not efficient, highly inefficient, in fact, but still independent. That's another good news story. The press in South Africa, very much independent. That's another good news story in South Africa. And the last piece of good news story in South Africa is that the returns in the South African economy can potentially be very high. One measurement is simply looking at the capital market in South Africa, offering you returns of approximately 10%, which is very, very attractive. You have to pay the Germans if you want to lend them money. We at least pay you 10% in South Africa over 10 years. So that's very attractive. And that goes for many other opportunities in South Africa. So my advice to people is look for those opportunities, stay in South Africa, make use of those opportunities. And remember, your first priority is with yourself and your business. Make sure it survives. And you can only make sure that it survives if you look at the normal stuff. So you have to know what is going on. Make sure you look after your cash flow. That is very important. Make sure that you can identify those risks in particular sector wherever you find yourself. And make sure you can manage those risks. And very important as well, make sure that you have a diversified portfolio. And a diversified portfolio also means that you have to make sure that a substantial portion of your investments are invested abroad. So that's the South African economy. I'm afraid we are in for some very, very difficult times. There are some, well, to call it green shoots is perhaps using some strong words. I'm not so sure about that. And also remember, there's a lot of technical statistical noise in all these numbers. So we're probably going to see a third quarter bounce in economic growth. But don't be fooled. Don't think the economy is out of the woods. It is going to take us a very, very long time to really get out of this hole in which we found ourselves, a hole that was mostly dug by the tripartite alliance under the leadership of the ANC. And I'm afraid the policies that have been put in place to get us out of this hole is just not good enough. Thank you very much for listening to me.
But thank you, Dawie. That was wonderful. Great. So our next presenter is Nedbank's chief economist and has been their senior economist since 2000. She received her master's degree in economics from the University of Stellenbosch in 1994 and soon advised government on economic procedures and policies in her capacity as economist in the Central Economic Advisory Service. And that's since been integrated into the President's office. Her experiences in the banking, securities, and brokering industries ensured her a broader knowledge of a wide range of fields within economics, including sector analysis, fixed investment trends, and the relationship between real economic trends and developments within the financial markets. And at Nedbank, she has focused most of her energies on trends in the overall economy looking at cycles in economic growth, inflation, and interest rates, which we all like to know. She regularly does talks all over South Africa to a variety of audience, from business forums, property groups, large corporate firms, and government entities. Her name is Nicky Weimar. So welcome to you, Nicky. It's wonderful having you. Thank you for joining us. It will be coming up.
My aim really today is to talk a little bit more specifically about the drivers within the property market. And I mean, I think that Dawie gave you a really good overall picture of the world economy, the movement in the dollar, some of South Africa's more destructive political dynamics. And my aim is very simply to sort of zone in on specifically the property side of things. So if we look at South Africa's performance, as Dawie rightly said, we entered this particular crisis, this pandemic, in bad shape. And unfortunately, that meant that whatever containment measures we implemented, that was going to be that much more dramatic. So just of exactly how the economy looks at this point. If we go to the next slide, I don't know if you guys can hear me, then basically you'll see a very sharp fall off in GDP. This is quarter-on-quarter seasonally adjusted annualized rates. And there is that dramatic decline. The bulk of the damage, as Dawie rightly said, was done by the lockdown specifically, but especially level 5 lockdown. So South Africa adopted one of the strictest initial lockdowns in the world. We didn't even allow sensible and safe industries to operate, like e-commerce. And consequently, in April, a huge amount of damage was done to this economy. And on a quarter-on-quarter basis, we contracted by 51%, which is you're just falling off the cliff. You're at the edge of the cliff. You've been sliding a bit, you've been holding on for dear life to stay more or less at the same level, and then lockdown comes, the virus comes, and you just fall off the edge of that cliff. And that means that, you know, we are now undoubtedly in the deepest recession we've been in since the Second World War, and we've been in a very, very long downturn in any case, where the economy per annum over this period have been contracting at 1.9%. So very vulnerable place. And then came April and level 5 lockdown, and an enormous amount of damage was done to the economy in that period. If we go to the next slide, there you can see that basically all sources of demand, remember, you need a form of demand. It's fair, it's fine if you can produce goods and services, but you need someone to buy it on the other side. All measures of demand except government spending collapsed. So fixed investment activity fell at the sharpest rate in recorded history. Consumer spending completely imploded. Government spending over the quarter contracted, but only marginally, by less than 1%. So really the reality is that this is where we find ourselves. We are now in a pretty deep hole, and the bulk of the damage was done in April. If we go to the next slide, there you can see that, you know, except for if we take where are we year to date, as of the end of June, where are we? And you can clearly see that this economy in the first half of this year contracted by 8.7%. That's a pretty vicious decline in GDP. And virtually no sectors were spared except for agriculture. So if it wasn't for the farmers, the picture would have looked even worse. And then government over the first half of the year, spending was positive, up marginally 1.1%. So that's where we find ourselves, sharp contractions in virtually every industry you can think of. So if we now say, okay, this is where we are, what can we expect going forward? So if we go to the next slide, and if we're now going to look at what we can expect going forward, we really need to think of it in terms of the property market. What do you need? What are the essentials you need in the property market for the economy to grow, for the sector to grow. And one of the key essentials is obviously the key essentials here for property to grow is you need economic growth to return. I mean, that's an absolute must, but not the growth we had prior to COVID-19. Everybody's obsession at this point, I know in business, I know in all the banking industries, in the banking industry, all the analysts are asking us, when will you get back to 2019's level? But for property really to undertake a sustainable recovery, 2019 isn't good enough. We need strong growth, strong enough for businesses start to look at the future in a different way. So businesses expect growing demand. And if they do that, they would also have to expand their staff complement. And that's when you start to get some job creation going. Now more people are earning an income, more people have the ability to spend. So you have rising disposable income, and with that you have rising confidence. Obviously, the other issues that are also important are things like access to finance and the cost of financing, which is all really about the existing levels of indebtedness in the economy and also the cost of credit, which is really your interest rate, because your interest rate is the price of money. Okay, so if we just leave this slide, it's fine. It's got a sequence to it. We can go to the next one. Let's have a look at our prospects for actual recovery. Where do we stand at this point? All right, so here we go. This is where we stand at the moment. So now you can clearly see we've got mining, we've got manufacturing, we've got and you can see the damage done in that red shaded area. That was level 5 lockdown. And even in level 4, which was still quite restrictive and infinitely more confusing as to what was allowed what kind of economic activity was allowed to take place and what wasn't. The reality is that a recovery already started the moment you started easing up in level 4. And since then, we have seen mining and manufacturing has been recovering. It's still below the levels that prevailed prior to lockdown and prior to this crisis, but it's been climbing pretty fast. So mining and manufacturing not looking too badly at all. Over July and August, we saw a bit of momentum coming through. I think a big reason for this is that China, and there's a lot of irony here, there's a heavy dose of irony, in fact. China obviously has had a relatively good crisis. They entered, the virus originated in China, so they entered a limited lockdown first, and they exited first. And so I think what you're seeing there is that China's economy is growing again. They were the only economy in the world that registered year-on-year growth in the second quarter. They continued to build on that in the third quarter. And we also saw in the third quarter that finally demand for commodities started picking up. So that probably helped both mining and manufacturing. Added to that, the rand, although it's strengthened quite nicely from its recent lows, is still on a year-on-year basis down quite substantially. So that could also have benefited some of our exporters. But the overall picture here is at least there's a little bit of momentum building up on that side. Will it last? Well, a lot of that will depend on South Africa's unique structural issues. The biggest challenge here is, of course, whether mining and manufacturing will have access to a reliable and cost-effective source of energy. Now, Eskom, they apparently have started a process that they call deep maintenance, and this will enable them to of the grid and the efficiency thereof. But the reality is that you can already see the disparity between what mining and manufacturing has done and what, in fact, has an reduction limited for mining and manufacturing by very real constrained energy. So another area I've seen starting is of lockdown. That continued into level 3, and we have also seen in August and in September from Nedbank's high-frequency point-of-sale devices, we have seen even further momentum coming through in September. These are official Stats SA numbers, so the September figure isn't in there yet, but August we saw nice momentum, and our point-of-sale devices suggest that that momentum continued into September. So recovery is underway. The consumer has started to spend again, partly because they have more spending options, because level 5 lockdown is at least behind us now. But again, if you had to draw a line to connect where we are now to where we were prior to the crisis, we are still well below those levels. This is just a bounce off an abnormally low base, and then we're probably going to resume that very flat trend. Vehicle sales will flatten out a bit. We expect that will probably, once the pent-up demand is out, start face some tough realities. Companies' profitability and earning hit very hard. Wages has been hit very hard. And so it's very likely that given this sobering environment, the consumers will probably remain very conservative in their spending. The recovery is underway. We do think at some point it's probably going to level out, and you're going to see that very slow growth we saw prior to COVID-19 striking the economy. So we go to the next slide. Then there are sectors that haven't recovered all yet. And the problem is, many of these sectors are in fact your main employers. Although South Africa certainly has a far more developed domestic tourism sector than, say, a Kenya or Namibia, the reality is the growth in our tourism, in our hospitality industry, and all time-related industries really been driven by international tourists, not so much domestic tourists. And as you can see, overseas visitors are still extremely at extremely low levels, virtually zero. We have now in level 1 started to lift those restrictions. The list of countries that can still not come to South Africa was recently reduced. In the beginning, when we moved to level 1, it was virtually every country on planet Earth. Now at least it has been reduced, but it still excludes some key markets for South Africa that are still not allowed to travel to South Africa. And as a result, the reality is, if you now look at what is unfolding in Europe, where there's a massive second wave, in America, where you are seeing in some of the Sunshine States another massive second wave coming through, the reality is that COVID-19 is still going to hurt global tourism, whether it be business and or travel related industries, whether it be for business travel or for leisure travel. And in fact, at the IMF meetings, the consensus was that it will probably take tourism another year before it starts to improve. And many people believe it will only start to really start rising and start showing actual signs of recovery from these low levels in 2022. Well, in that case, a lot of South African businesses are in trouble. And also a lot of jobs are compromised. So unfortunately, this is one element of our economy that's very labor intensive, that has not recovered, and where COVID-19 is probably going to remain a very depressing force for quite some time to come, probably deep into 2021. If we then go to the next slide. So we are in the process of a recovery, but that recovery is a very mild recovery. Is that recovery strong enough to bring about a revival in fixed investment activity? Remember that fixed investment activity, the expansion of capacity by the private and the public sector, this is the key driver of job creation. And that's what you need in South Africa. And if we look at what's been happening to fixed investment, you can see All major stakeholders have cut back on fixed investment activity dramatically. But the biggest drag has come from the implosion in fixed investment by state-owned enterprises, the red line. But you can see private sector fixed investment initially held up fairly well. It didn't grow, it just held steady. Now it's also imploded, and then capital expenditure by government has also come down very sharply. Now, from this position, the kind of recovery we're envisaging, is that going to bring about any pickup in fixed investment? There'll be some degree to which fixed investment will accelerate. We are already seeing a lot of companies undertaking or announcing plans to undertake certainly automation strategies and investment and to further their digital journey. Unfortunately, this kind of investment doesn't create jobs, all right? Not for the type of labor force South Africa has, which is, of course, unskilled labor force. The type of investment we need for that to occur is where you open another factory, where you build another commercial property, where you put up another commercial property development, another residential property development, where you have mass construction works. So government clearly wants to bring about that type of investment. And in the president's reconstruction and recovery plan, that's really what it is on. It's on a public sector investment drive, and partly wants to finance that through changing Section 8 of the Pension Funds Act, which will enable them to access private in order to make it possible, and that more of that anyway towards infrastructure spending. Now, government has a very, very poor track record in delivering on capital expenditure. State-owned enterprises have a disastrous track record delivering on infrastructure. They have never been able to deliver infrastructure budget or on time. And Maduna can see examples of that. And the state's inability to infrastructure isn't just due to lack of skills. A factor, it's not just due to a lack of capacity. That's been a big factor. It's also to a large extent due to really blatant corruption. And now essentially you're asking South Africans to this leap of faith that this time is different. I think it would probably have been wiser to first illustrate that delivery with the existing budget you have before you go and change rules and regulations in order to access more funds for an infrastructure drive. Highly unlikely you have the capacity to do. Now, I do know a big part of this plan is to encourage the private sector to join the party. Now, if they can successfully succeed in doing that, then the outcome might be very different, because the ability to plan, implement, and make capital expenditure projects, that ability still very clearly resides. It's going to be quite difficult to get off the ground to start out with. So what does that mean? Job creation is probably going to be quite restrained for quite some time. You probably all saw the second quarter employment numbers, and the unemployment rate is really very strange, even though the level of employment dropped by 2.2 million. That is really because a lot of people left the labor market or the labor force simply because they knew business were closed, so there was no point to go and look for it. So these unemployment numbers not very useful at all, because they are distorted by the impact of lockdown. But we do know that from the latest survey, about 2.2 million people lost their jobs. The reality is, unless a revival of fixed investment, re-employment will only probably occur at a very slow pace. What will make it even worse, as I said, we do not think tourism and hospitality is going to recover in a hurry. And so employment products also remain quite depressed. With the pickup in economic activity, some people will be re-employed. Will it happen fast enough to address the 2 million people be a slow and gradual process. So that means income won't recover quickly. Here I show you consumer spending and personal disposable income, and you can see it took a massive hit. So income really is a key input into whether people are willing to go out there, take out a mortgage and buy a property. And it's not just your income today, it is your expectation of what your income will be tomorrow. So given that fixed investment imploded, that the economy is probably going to recover at a slow pace, and that employment or re-employment of those that have been retrenched also occur very gradually, I think that expectations of future earnings will also remain quite depressed. Wealth effects, well, it took a big tumble in the first quarter, obviously, because that was the point that the global investors woke up to the threat to COVID. We had a major risk-off event. Global equity markets imploded. And then in the second quarter, the global markets lit the JSE up. If we look at the breakdown of that improvement in net wealth, so in South Africa, the equity markets recovered, but you can see it's been predominantly driven by that red line, which is resources. Everything else have been flat. So it's a very narrow recovery. But nonetheless, if you bought gold, if you were holding mining shares, then you have seen the benefit of that recovery. And that recovery has, in fact, been very, very strong. Resources now trading well above the levels they were pre-crisis. Big questions as to whether that is sustainable. But that's certainly been the main reason for the improvement in net wealth. The next factor, obviously, is if you hold bonds, if you are sitting with a very high and very steep yield curve. So the Reserve Bank's been cutting interest rates on the short term, and that's been dragging the short end of the curve down. But over the longer term, you've got on the yield curve all these fiscal risks, which Dawie spoke about, which is being priced in. So even on the 19th of October, if you look at that green line, we still have a very, very steep yield curve. Now, that is your return if you're a bond investor. So that probably also contributed to some extent to wealth. The irony of the situation is, I can tell you as bankers, the best investment we can currently make is to buy government debt. That's where we'll find the highest return. It is a more attractive investment than actually lending money to households and companies. Now, that's not a healthy situation. That situation has to change. So government has reached the point where it's completely crowding out fixed investment. And certainly the flow of credit to the private sector. So house prices, your financial assets, we've seen these big movements in the equity market and the bond market, these enormous gyrations from risk off back to risk on. But in house prices in South Africa, we've been in this very flat sideways drift for an extended period. And even though interest rates are at decade lows, the reality is there's been no uptake or lift in house prices at all. And that really reflects that underlying uncertainty among households about their earnings, about their jobs, and about certainly future growth prospects in this economy. All right, so wealth effects, there's been a few of them. It's not so overwhelmingly negative. If you were invested in the equity market, you've seen a bounce. If you were invested in the bond market, you're getting a higher return. But really, it's financial assets rather than real assets where we see some gains and some improvements. And so consumers are very conservative at the moment. And there is no better evidence of that by looking at South Africa. We are not big on saving, right? So we're not big savers. We're not very good at it. But you can see over the last 2 quarters, the first quarter and second quarter of this year, that South African consumers have actually started saving more. And that shows you how worried they are about the future. It's precautionary savings. It's making sure you've got something put away for a rainy day. So consumers still very uncertain about the future, and uncertainty isn't good for growth. But when we look at access for finance, our household borrowing actually slowed down in the first half of this year. So consumers are very conservative. What we saw in the banking is that we saw very double-digit growth in household deposits. So people are putting money in the bank in savings instruments, but they're not borrowing more money. So growth in credit extending household sector slowed down, but indebtedness increased. Now you may ask me, Nicky, how on earth does that work? Well, it's because income imploded. We express household debt as a percentage of income, and you can see as income imploded so much faster than debt slowed, we saw the ratio of household debt to disposable income jumped from 73% to 85%, which takes us very close to the levels that prevailed prior to the global financial crisis. So that will obviously impact households' ability to get a mortgage, lest that picture corrects. Now, as we go into the third quarter and the fourth quarter, income will obviously recover, and this anomaly will to some extent correct, but it's still going to be sticky at a higher level because the growth in income will be modest. All right, just showing you that mortgages have been slowing and it's sort of reaching a bottom. I'm going to go through that very quickly. I want to get you to interest rates, so let's move on. So let's talk about interest rates. Well, interest rates is really a function of what happens to inflation. Now, at the moment, inflation very well contained, hovering at around 3%. The Reserve Bank targets the midpoint of their range. Their range is between 3 and 6%. They target 4.5%. So we are below that level. We are below that level. Why? Because demand is weak. When domestic demand is weak, it is virtually impossible for wholesalers and retailers to increase their prices without hurting their sales volumes. So weak demand has kept inflation in check and will continue to keep inflation in check. If you'll see food prices, it did start to rise towards the end of 2019 and in the early part of 2020, it's up in the corner and it's starting to fall again. So food inflation is not a problem. Oil prices took a mighty tumble. It's one of the big reasons we are now at an inflation rate of less than 3%. And it staged a bit of recovery and then that really ran out of steam. Why? Because there's a second wave of COVID-19 infections forming around the world. Just as somebody started easing lockdown, they're now finding themselves they have to reimpose certain restrictions. And as such, global demand hasn't picked up to really support high oil prices. And in fact, we think that type of situation will probably prevail for the rest of the year, and we'll only see oil prices start to rise in a more sustainable manner from around the second half of next year into 2022. So oil is not an immediate threat to inflation either. So the only key concern is the rand. All right. So the rand been all over the place. March, obviously, mighty tumble. Then Moody's downgraded us to junk status, so we went to universal junk status. Then the rand took a further tumble, and since then the rand's been pulling its way back, but it's been extremely volatile. It is still very to the levels where it was last year. Now, the main reason why the Reserve Bank's worried about the rand is it can be inflationary, but I don't think that in this environment, weaker rand will result in higher inflation because, like I said, wholesalers and retailers cannot pass cost increases on to consumers. Demand is too weak. So they're going to have to absorb it. But, of course, if that for an extended period of time and the rand weakens and continues to get like Argentinian type of picture, then people will have prices higher. And it's that breaking point which the Reserve Bank to some extent are concerned about. The point is inflation is really not our concern at this point. Demand's too weak to create inflation. But the Reserve Bank needs to finance and attract funding to finance a massive fiscal deficit and basically to finance a current account deficit. And that means, unfortunately, they cut interest rates probably as much as they can for now, and we believe rates will remain flat for an extended period. So at some point, this must help the property market. Okay, it must. Low interest rates, property prices very low. At some point, it has to translate into some demand. When is that going to be? Not this year, probably towards the end of next year. Okay, that's my tale. And for now, I'm going to stick to it. Okay.
Thanks very much. Thank you very much for that. Great insights, and you painted a very clear picture of where we are and where we're going.